Hi everyone, my name is Kenneth and I'm partner of Michael. And for my part, I will start talking about like business size tax update. And I will try to go one by one all the tax update topic, but because the time limit, so I might go really fast for each one. For my part, I will try to focus on it's called like 199A deduction. It's something like a 20% business deduction. So I think it's really important for everyone. For the tax rate, so the new tax reform try to reduce the tax rate and simplify to only 21%. So we can tell from the old rule, we have different kind of tax bracket for different income level. And for the new rule, it's kind of nice, only 21% is really easy to calculate. And for most business, we can tell we'll get the tax benefit on it because really low tax rate. Only the first level is if business make taxable income less than 50,000, maybe expect to pay more tax on it. Dividend received deduction is something like the company own another company with certain level of ownership will get the percentage of the deduction. So there's a table here. From the old rule, we have like 70%, 80%, and 100%. If the company own more than 80%, actually it's the same. We can take like 100% deduction when we receive the dividend. But for the first and second level, it's reduced from 70% to 50%. And the second level is reduced from 80% to 65%. So it's kind of bad, but it's just a little bit, it's not too much. And the new law is add one more additional benefit. Is if the US corporation owns specified 10%, foreign corporation will get 100% deduction from the dividend received. Bonus depreciation is kind of important too. We used to have only 50% bonus depreciation, but the new tax reform tried to increase to 100%. So the rule start from September 27, 2017. It's kind of funny, when we filed the 2017 tax return, maybe individual tax return too, when we file the rental property, take the bonus depreciation, we can see like 50% and 100%. Depend on the asset, like which day you buy. If before September 27, it's only like stay with the old rule, 50%. But after that, will be 100%. And it's last until 2023, and it's reduced every year. And maybe after 2026, will be disappear. Yeah, for a while, maybe.
So this is only for new assets?
New asset. It's a good question. The new rule also add used asset too. So if the used asset purchased after January 2018, it can take the bonus depreciation around. So yeah, it's kind of nice.
But I'm sorry, right now rental property, they say calculated by like 20 years, right?
20 years.
Yeah.
27.5 years.
Yes, exactly. So
yeah.
Now, based on the new rule, which you can deduct 100%?
It depend on what kind of asset.
I'm just talking about rental property.
Yeah, rental property, if you buy like, not the building though, maybe you buy equipment, you buy like the machine or maybe the refrigerator, you can take a bonus depreciation the first year.
But how about that property, really like a house, rental property?
No, it's not for the bonus depreciation. Yeah. It's need to be like 27.5 strict line.
Okay.
Yeah.
Going back to the automobile, if you're leasing, then it's still the same, right?
Still the same, yep. Section 179 deduction, on the old rule is 500,000, and if the total asset purchase over 2 million will phase out. The new rules try to double up, so for the business owner, it can take like 1 million, and then phase out amount will be 2.5 million. And the 179, the new rules try to expand the definition and also include an improvement for the roofs, heating, ventilation, air conditioning, fire protection, alarm systems, and security systems. So it's kind of like try to give like the list so you can see like which one can take that 179 in the future. And this is the question too, like the recovery period is increased. So from the current rule, we can see from here, qualified improvement properties, we can only depreciate like 15 years. It's increased to 20 years. And non-residential real property, 30 years to 40 years, just 1 year more. Rental residential real property will be like rental property from 27.5 years to 30 years. And the foreign residential or non-residential property is still the same, 40 years. So the recovery period increased. That means every year we can claim the depreciation maybe less, and then in the future it's kind of bad for like the landlord, rental property owner.
Is this for only newly acquired properties, or?
If you acquire after 2017, then it will be stick with the new law. Yeah.
So the properties that you already depreciated, you stay on?
Stay the old, yeah, the grandfather rule. And just one more thing is the new law try to simplify the tax. So we used to have like different kind of improvement: qualified leasehold improvement, qualified restaurant improvement, qualified retail improvement property. So it's just try to consolidate into one term. It's actually in the old rule is still like 3 different names, pretty similar, but just try to like consolidate in one term. Just make it easy. In meal entertainment, the new tax reform try to get rid of the entertainment expense. So from here, I just try to list out here everything related to the entertainment will be not deductible in the future. Only the first one is kind of nice, office holiday party, entertainment. I think every company, we always has like Christmas party or all kind of party, but if maybe the employer couldn't take any deduction and they just kind of like, skip it, it's kind of bad for the employee. So it's kind of nice from government. Yeah, I think we need it. And yes, from here, so entertainment relate meal, club memberships like golf club and a sport ticket, no deduction in the future. And the last one is the meal provide for convenience of employer. So from the old rule, we can deduct 100%, but in the future, 50% only until 2025. After that, no deduction.
Sorry, what's the transportation for business meals? Is that if you go to a business lunch and you need to drive there, then you can deduct that?
We call that like travel meal. So when you go like travel for business purpose, the meal can be deducted 100%. Yeah.
Oh,
Yeah, the business.
Sorry, I'm still not clear on the repeal 50% to 0, the entertainment-related meals.
Mm-hmm.
So if it's a business, not a party,
Mhm.
but if it's a business lunch,
Mm-hmm.
until last year it was half,
Yeah.
now it's 0.
Oh, actually, business meal is 50. So the second line I mentioned here, 50%. But it's kind of hard to say, right? Like business, maybe sometimes entertainment too. So it's need to prove like it's business purpose. Better to have like the client name, what kind of purpose on the receipt. And then if IRS have a question, you can just show, for that kind of purpose, I have client name and it's really business related. It's not entertainment at all. It's not like Friday night with the client hangout. It's not like that. It's just proof. Net operating loss, NOL. In the old rule, we can carry back 2 years or carry forward 20 years. For the new tax reform, try to skip like the 2 years carry back. We can only carry forward 20 years. And one more restriction, the NOL carryover deduction can only offset 80% of the taxable income. So, yeah. Okay, so this is the biggest change from the tax reform.
Can you go back to the previous slide?
Oh, okay.
Like the 20 only, no 2 years carryback. Can you explain that a little bit more?
Yeah, so the NOL, the loss can carry over 20 years to offset the taxable income, but no carryback. In the old rule, we can carry back the NOL. Maybe like 2017, there's the loss, and maybe 2016 have a gain. You can amend a 2016 return to get a refund or get a refund back.
Oh, so you can deduct your future gain, but not previous years.
Not previous year, so only future. Yeah. Okay, so 199A pass-through deduction. Some people refer that to 20% business deduction. Pass-through deduction actually is from the K1 we call from partnership, LLC, S corporation, and also include the Schedule C sole proprietorship. And then the calculation is really complicated. I will try to simplify. I have an example to explain. So the calculation is, I list out here, deduction limit to 20%, 20% of lesser of net qualified business income. We call that QBI, or taxable income before the deduction and after the net capital gains. And there's a phase-out range. Phase-out range means if the taxpayer has taxable income above this number, then the deduction will be loose or maybe have restriction on that. I will explain more. So the phase-out range for married filing joint will be 315,000 to 415,000. For other filing status, will be 157,500 to 207,500. And when the taxpayer has more, the taxable income above the range, then we need to think about the business, what kind of business they are doing. There's a list from the IRS they call specified service business, and it's including the healthcare service performed by doctors, nurse, and dentists, and also include the lawyer, the CPA firm, like us, is a bad news, and accruals service, and also performing arts, consulting, athletics, and the good news is for engineering business and architecture is exempt from this category, so it's good. It's good. But I just want to mention that when you really think about set up a new company, be sure, because engineering always relate to consulting. So all the legal document or maybe tax return and register with state, better say engineering service, not consulting service. Just try to avoid any confusion or maybe trouble with IRS. So be sure to do that. If the business is under the specified service business and above the phase-out range, the taxable income is too high, then it will lose the entire deduction, so no deduction at all. For all other business, it still have a hope, even though has taxable income above that, but there's just more calculation on the restriction, so it go even more complicated. And the calculation is here, deduction limit to greater of 50% W2 wages, or the sum of 25% W2 wages plus 2.5% and adjust basis the fixed asset. From the calculation, it's really hard to say how to calculate. Yes, really hard, but we can tell W2 wages and the asset, fixed asset. So I will show you guys how different from paying more W2 or buying more asset can affect the deduction. So for business, in order to take the deduction, need to have qualified business income, QBI. The QBI must be US source income, so no foreign source income at all, and it cannot be any investment income. The good news is include rental income. So I tried to research it, I tried to read some article from IRS, and it didn't say if the taxpayer need to have a business to hold a rental property. So we might see in the future, even though rental income from the Schedule E can still take the deduction, but I can say 100% we can do that. But in the future, we are still waiting for the guidance from the IRS. Maybe we can do that, but we'll see. And there are two more things. The partnership guarantee payment to partner is not qualified as QBI, and for the salary paid to S corporation owner is not qualified to a QBI too. So when we calculate the QBI, we need to add back those deductions. Yeah, to get more. Yeah. There's example here. So I try to put some number here, and again, calculation is not easy. But for the first example, actually the taxpayer own a high-tech company, so engineering. And assuming he's single, his taxable income is lower than the phase-out range. Then when we calculate the deduction, we calculate 18,000 deduction allowed, and for his situation, actually he can take the 100%, so 18,000 allowed for his business. This is kind of good, taxable income 90 and 18,000 deduction is allowed. The second example, Bill is a doctor, so he owns a clinic. It's bad news when we think about his doctor, then it's specified service business. And assuming he's single, he has taxable income way above the phase-out range. Even though we calculate the deduction allowable is 40,000, but because he's a doctor, then he earned a lot more than the phase-out range, then no deduction allowed for him. it's kind of bad for doctor. Another example would even go more complicated, but just want to list out that we assume those three situations, three scenarios, they are not specified service business. There's some kind of maybe engineering business. They all have the same taxable income, and we calculate the same deduction, 20% business deduction. But just try to show you guys, I put like, we need to calculate, because above the phase-out range, we need to calculate how much restriction apply to that and how much deduction they can take. From the first example, the scenario A, the company actually has 1 million on a just basis of depreciation asset, so fixed asset, but pay no W-2 wages. In this example, we calculate 80,000 available deduction, but the company can only take 25,000. The second scenario B, the company actually the other way has no unadjusted basis on a fixed asset, but the company paying like 300,000 W-2 wages. In this case, he can take 100% because 80,000 available, and he can take 100% 80,000 deduction, which is maximized, the max. Scenario C is kind of combination in between two. The company paying W-2 wages 100,000 and has some unadjusted basis of fixed asset 400,000. In this case, we calculate restriction. After restriction, the deduction is 50,000, which is about like 60% of the deduction. Just want to show here, it seems like the scenario B is the best because maximized, but when we think about when you pay more W-2 wages, the company need to pay more payroll tax. Overall, it's not a good deal actually. Yeah, maybe like for tax saving purpose, it's not the best scenario. And for the scenario A, pay no W-2 wage, but with the fixed asset, when company buy more asset, then more personal property tax need to pay. Then it's hard to say it's good or bad. But for scenario C, maybe it's the best combination between two. So pay some W-2 wages and buy asset and still take 60% of the deduction.
So for the high tech, does it apply?
For the high tech company, yeah, this is applied to restriction high tech company.
Okay.
Yeah, if the high tech make a lot more than the taxable income, the phase out,
Okay.
then this is like exactly for the high tech company the same situation.
Thank you.
Yeah. So I want to mention that like it's really critical for the tax year, the year-end planning, because the company can still pick up like if thinking the company want to take more deduction on that, still like year-end bonus, pay more, or maybe purchase more asset at the end of the year, then try to maximize the deduction. So yeah, it's some kind of strategy here. R&D credit is actually still the same, no change from the new law. It's still technology in nature, process experiments, and need to be domestic, no foreign. And it includes wages, contracts, supplies. And one more thing I want to mention that the R&D credit can offset payroll tax. So in order to get that, can claim the credit on the payroll tax return in order to get the refund back. Another big change, R&D expenditure. The new rules try to, the R&D expenditure need to capitalize and amortize over 5 years. And if the R&D perform outside US, then 15 years amortize. So the good news is only start until 2022. So for the business, still have time to think about spend more right now to maximize the tax benefit. Business interest deduction. So just wanna mention that, but the calculation is not easy too. But there's some restriction on that. It's only applied to the large corporation. The business make gross receive more than 25 million. So for most small business, it's not applied at all. 1031 like-kind exchange is the new rule only limit to the 1031 exchange to only apply to real property. So for investment property, exchange to investment property or rental to rental, still fine. But all other kind, not at all. When I go through it, it's kind of funny that why government want to set it up, because the Bitcoin, everyone's selling Bitcoin, trading Bitcoin and make a lot of money. And some people even really smart, they try to exchange Bitcoin to some other coin. I don't know, it's like Litecoin or something, and even like some other kind of virtual currency. And when doing the 1031 exchange, when you exchange that, no gain, the gain will defer, so no tax paid to IRS. Government just doesn't like it, and they just set a rule like that. Say from 2018, no more exchange for Bitcoin or other kind, only real property. And another good news is if you have any kind of 1031 exchange still open at the end of 2017 and closed in 2018, then even though Bitcoin is still okay because old rules. So yeah, just something good. Corporate corporate AMT repeal. So under the new rule from 2018, the AMT credit can offset the regular tax for company, the corporation, and from 2018 to 2022 is refundable too. So be sure to see if any kind of tax can save from that. Domestic activity production deduction repeal. So it's bad news for manufacturing company. No more deduction at all. And some more foreign reporting. I know Michael already mentioned the FBAR. I just want to mention this is the business size of foreign reporting. There's so many different kind of foreign reporting, but I just list out the most common forms here. The first one, 5471, if the U.S. person owns foreign corporation or U.S. person is the officer of the foreign corporation, need to file the 5471 to show it's not an easy form, it's really complicated, and we also need to report the foreign corporation financial statement on the tax return, so it's really time-consuming and messy. 5472, the other way, is U.S. corporation, 25% of U.S. corporation owned by the foreign corporation, and there's related party transaction in between, then the company, U.S. corporation, need to file the 5472. And the last one is kind of common and so many people miss out. We call that 8621, we call it PFIC. This the U.S. person own foreign corporation or foreign company and the company doing the investment activity. I see the most people own the foreign mutual fund is also required to file the form 8621.
Quick question on the previous slide, right?
Okay.
So regarding the first form 5471, if you're not a shareholder or on the board of directors, if you're just like a say high-level management of a foreign corporation, do you need to file that form? Management,
they define that to officer too, depending on what kind of position. If you're only an investor, then it should be all right. But
if you work for that foreign corporation, say, at a mid-level manager, is that something?
I think mid-level manager should be all right, should be okay.
So officers are basically C-suites, CEOs, CFOs, those
something like that. Yeah, so only managers, so it should be okay.
What about VP, vice president?
Maybe officer too. Yeah, have the kind of controlling power or management decision.
Okay.
Yeah, just try to get rid of the position. Maybe manager is fine, or employee, but just, the contract, don't say officer, director, or something like that. Okay, and the penalty is 10,000 minimum, and it can be more. It really depends. And I want to mention that there's a program called OEDP. If any one of you or any US person that think they miss out filing in the past, there's a chance to file back. The OEDP program need to be asked for the attorney, lawyer advice, and it's still penalty apply even though join the program. It's kind of bad, but the penalty can be reduced, lower, reduce the penalty, and the bad news is IRS try to stop the program. So they try to stop in this year, September or October. So if you think you miss out reporting on that in the past, just talk to a CPA like us or lawyer as soon as possible to catch up. Okay, and the end of my part.